What's going on, YouTube? It's Merc here. Today I'm going to bring you the first option strategy that I fell in love with because I think there is just an absolute lack of content, specifically free content, on how to build a trading strategy around options. So essentially what you're going to see under my chart here is the trading strategy and the thesis that it revolves around. I'll run you through it real quick and then we'll go through a couple live examples and how it plays out. So essentially we're trading right side of green. So what you'll see here is that in a bull market there's going to be 5 motive waves. Motive waves consist of 5 structures, and a motive wave intends to move the market in the direction of the trend. So we're in a bull market. So what we're going to see on this, I can't see my cursor. I didn't really think any of this through. Oh, you know what? I have it on another chart. Hold up. I got it. Oh, yeah. All right. So this is 1, 2, 3, 4, 5, but it's also filled. It's a fractal, so it's like a Russian doll. So 1, 2, 3, 4, 5, A, B, C, and on the bigger count, it would just look like 1, 2, 3, 4, 5, A, B, C, and then you can add smaller waves as you go down. But essentially, the more accurate you are with your predictions over the long term, the better your probabilities are. So what's awesome about Elliott wave theory and why I like it is it's not telling you what's going to happen. No, it's a probability model. So it's allowing you to build a couple different trading theses, which you can use to develop a couple different plans, and then you trade around those plans. So what I'm going to show you today is a simple way of how to trade around a corrective pattern. And this corrective pattern happens to be the most common corrective pattern you will see. It's a simple ABC, and the rules to it are listed to the bottom left of my stream here. A is going to be the key that you use. So you will draw a line from the top of A down to the low of A, and then you will draw a fib retracement. Now, you drew the line because you can duplicate it and then pull it all the way over and use it for your estimation of C. So B will land in the 50 to the 85. We will show you that right now. So like I said, I'm not recommending you use this on anything other than a scalp, but I am going to show you how markets move in a fractal nature. So what we're looking at is the SPY weekly. And this is way back in February of 2018. So what we saw was a 3-wave corrective pattern. And how I'm going to show you that and how you would build your trading thesis around this is labeling it. So your A is from the high to the low. And because it's a weekly chart, we're actually going to cut it to the candle, just because there's so much data that could have happened in that week that we don't want to assume. So high to low, and then your B will come back up, and your C will come down. So your A is your key. You're going to measure your A by drawing first a line from the high to the low, duplicate that line, pull it over. Now you have a length measurement of A. The next thing you're going to do is draw a Fibonacci retracement, which is a high to a low, and then plan your predictions. So I always go 78 to 68 on my B, but I know that it's valid from the 50 to the 84, right? So that's my thesis. Now, what I'm looking for is, hey, does SPY shift here? Like I spot the corrective pattern. So I plan my prediction. Does SPY shift in this box? Well, here's the cool thing. Your A also serves as a guide, a general guide for one of the measurements that C could be. Now, how do you measure C? It's 1 times the length of A. So remember when we duplicated the drawing? Well, I just put it here, and I'm going to draw a gold box at the bottom of it. And this is where it was telling us, our Elliott wave was telling us to enter. Now you'll see how this plays out. You'd be entering in a wave 5 here. That'd be a 1, 2. So yeah, so you're entering into the end of a wave here, and it's going to be a different type of correction, but you would have been able to catch the swing from April to July when the market SPY went from 260 to 290. So that's a simple method of how you would utilize trading right side of green. So you're waiting for a big dip, and you're like, hey, I got my dip, right? And now you use that dip to make two predictions. One, where the bearish pivot will be, where the bull trap is, which is your B, and then 2 is your C. Now once you make those two predictions, you can then set an alert on the line of B's and C, right? And then as the stock plays out, if you get confirmation bias, you enter the trade. And then what I like to do is, because it almost always, if you enter the trade here, there is a chance that it could turn in. It doesn't have to retest to 5, right? So you won't know what's happening. You'll know this. So if you enter the trade here, right, and it goes a little red against you, you're like, shit. You're kind of chilling because it's still in your box. It goes up. You're like, cool. Goes down the next week. Goes up again. What you can do is you can pretty much assume that this will retrace to at least the 50% of A before it possibly rejects, right? Because as you hold this box, that gives you a little bit of buying power to get up. So what I do, and again, I'm talking about on a scalp, but I'm also showing you on a weekly chart. Let me pull up a day chart of something. I think the NASDAQ just corrected, didn't it? Cool. So what do we see here? Do you guys see your ABC yet? I'm going to pull up a bigger time frame so it's less messy. I like to use the 9-minute. It seems to be pretty clean for me. This is QQQ. I had a bearish forecast coming from here. We actually smashed through it. But what you can see is the rest of the market was kind of bearish too. Everyone was a little bit hesitant. This is when they were talking about interest rates. And no one wanted to leave their money in over the weekend. Everyone was a little worried about Monday. So I had a bearish thesis here. Lo and behold, we live in a speculative world. Money doesn't really matter. So why would inflation or valuations? But I'm not complaining. So we gapped up. Now this is your green. You want to trade right side of green. So now you're just going to wait for a corrective pattern. And what do we see? Well, we see one here. So you're going to wait for your high to your low, which is A, B, and they are this easy to identify as you get going. So now, how did I identify this? Well, I identified A, and then I'm waiting for B to pivot, right? The second B pivots, I'm seeing where my entry should be. Now, if it doesn't make it to my entry, I don't want to enter. I didn't hit my box, right? So remember, this is how we'll do it. So this is going to be a fib retracement from, and because we're using a tiny frame now, you're going to retrace every inch of this candle. It's not a weak chart. It's not hiding days of data. So you're going to retrace all the way to the low, high to the low here, and then you're going to draw a line from the high to the low, and then draw your expected B pivot, which will be the 78, the 61 for me, but you could trade all the way to the 85 to the 50. So this is my expected pivot range. Now, so stock shifted here, and I'm expecting it to pivot here. as it starts to come back down. So the stock comes down and flies back up. It shifts. Now from here, I need to draw. So again, this is what you'll have seen. So I'm going to take my high to the low. And as the, remember, we did, so, and then I'll draw the gold box at my buying zone. And I set an alert on this saying, hey, if it crosses this into this range, I want to buy alert. So thinkorswim goes ding, and then I know to take a look at the chart and attendees or a rejection. I also put alerts in for if it invalidates my theory, because then I have to come up with a new one. So as you'll see here, though, if you stick with those two rules and you identify an ABC correction, you're going to be able to find these high probability trades. This would have told you not to enter here because it's not even close to the length of A. So while everyone wants to enter here, this is a big bull trap. So everyone, it started to come down, and this is at 10:15 in the morning. Everyone's been used to this big bullish market. We've been running since Monday. It started to come down. Everyone started buying. We didn't fully correct, so we rejected here, and then we finished our correction right in our expected pivot. That's where you would enter, and then you can ride that for the rest of the day if you're using a trailing stop loss, or you can simply sell at your 23 to 38 or your 50 range. I generally like to sell at the 61 range, because that tends to be what I find is the strongest resistance. So the most often that I'm rejected on this theory is at the 61.8 range on the way back up, which you'll see here it kind of did. So it rejected on the way back up. That tends to happen occasionally at the end of the day too. So I generally profit take in this area. Now, that is a very simple scalp, and I'm going to go ahead and show you about 5 or 6 more charts that you can do this on, and then hopefully you have a basic understanding of how to identify a 3-wave corrective pattern, and then how to predict the price action of where the bull trap will be, and then even better, how to predict your target entry. These 3 things will stop you from buying calls at 9 in the morning when the market makers are just caking on premium. It's just the pattern we're in right now. We left a very bullish trend, and when we left that trend, market makers have just been crushing it in the hedge funds on selling options. So to avoid that, right, because they're crushing. So if you look at AMC, how it trades, we'll pull up AMC real quick. To avoid the IV crush, just take a look at the pattern of how AMC trades, and that'll kind of give you a pretty good indicator. So aside from Thursday last week, where we went from 53 to 63, there hasn't been a day this, oh no, I'm just kidding, Tuesday. I should restart on all of that. I was off a couple weeks, first off, and no. So let me zoom out and show you a little better. So when you're looking at, when you want to go long in calls, what you're looking for is a period of low volatility where you have room to run. Now, what AMC is at this state, when it dips real low, I was still making money. So I still had room to run for my calls to compensate for how high the implied volatility was. So I could buy an out of the money call, and as it ran back up, I could still make money. Now, this was the week I started losing money. And then as I got into this week, I stopped trading AMC for another 2 weeks for going long on calls, just because I identified, hey, once we rejected here, I didn't want to trade options in this death channel until we get to the end of it. So currently, my thesis states that we are at the end of it, and that we should see, it's a symmetrical triangle, we should see, it's a weird corrective pattern formulated of 5 waves of ABC. So ABC, ABC, ABC. You'll see it as it goes. But my point is, you don't want to trade calls in this death channel, because that's how you lose money. So when you're trading options, what you're looking for is the right side of green. So as we hit here, we're right side of green. That's a good entry point. Now, as we come back up, the volatility is spiking. You don't want to buy calls here. It's a really bad idea. So why is this so hard then? Because you're essentially trying to catch a falling knife. So that's the logic behind why I like Elliott wave theory, is it helps me enter when volatility is low, while also avoiding the tragedy of catching a knife, which I think we've all done. So this is our ABC corrective pattern on AMC, and I'm going to show you some ratios. We're in a 2-hour chart. It's not going to work very well from that for what we want. So because AMC is in a corrective pattern, you don't generally want to trade it. What you want to do is predict where the next pivot will be. So when you get to the bottom of the channel, sure, you can go long on a call, but look at how tight these days are. I mean, as an options trader, it's really risky to go into a stock, right, that almost needs to be swung for a day to be profitable, but alternates from bullish to bearish all the time. But yeah, they selling their calls in the morning. Don't buy them. Just not a great time to buy AMC calls. Now let's take a look at another stock. Let's do, you know what's been getting a lot of hype? I want to do some Wish. Oh, this is a wonderful one. Look, so this rejected my thesis. Okay. So I anticipated this shift from here to have meant something, and it really didn't, because as we came back up, we continued to just fly past 4, and then we never broke back down. So for the rest of the day, I kind of sat here wanting to take this trade. Lo and behold, the very end of the day it did. Unfortunately, I was just excited about the trade, so I entered and then sold for a loss the next day. Excited to hit my zone. I shouldn't have entered it because it wasn't the 333 pattern, and it didn't do what I predicted. Me entering this was an unforced error, right? And when you trade options, you got to limit those. So keep it simple. Have a plan. Let me show you some more corrective patterns. Let's do Corsair. Problem is, these all just entered into bearish patterns, like my entire portfolio, my entire watch list. Let's do AMD. Let's try to get some love today. Wonderful. So this is a 3-wave corrective pattern, and we're going to go up to our favorite time frame, which is the 9-minute chart, and then that should show us a pretty good view of it. So the high to the low that you're looking for is from here to here. I'm going to activate this just because we already see where the B pivot is. I'm just going to show you real quick. So we're going to activate this, and this is telling us we should buy down here. So you put your expected range down here. The stock bottoms off this support. As it comes back up, you can enter. So let's show you the retracement for that part. So your A to your B, and then your gold box is going to be your 70 or 80 to 50. So that's my entry. So I identify A, I anticipate B, and then I use A's length to gauge where C will pivot after B. Now, this isn't saying this is going to happen, right? This is to increase your probability of taking a successful trade. So every time you see this 3-wave corrective pattern, try to chart out where you think it's going to go. So if you see a bullish stock in the morning, gap down, right? This one happened really quick, so I'll show you it. So your high to your low, We have to go to a smaller time frame for this one, but it did happen here. Okay, ready? So another three-wave pattern. The market opens up. You say, oh shit, look, we gapped up. And then we start gapping down. You're like, sweet, this is awesome. It's going to make me some money in a few minutes. So you take your fib extension, high to low. Okay. Draw your expected pivot range. Great. Now you're going to do an A, B, and then a C. And what do? We take the length of A, and boom, and then we go activate it. And we bring it right over to B. And this is, as B pivots from here, you would pull it. So you're not going to see B, right? So you're going to predict B, and then B happens, and as it turns out, your prediction was right, correct? So you grab your trend line, and you put it at the top of B, and then you draw a gold zone. Now this gold zone becomes your buying range. Cool. Draw a little alert. Look how this trade turned out. So my point is, if you can identify a trading pattern and then create sets of confirmation bias to ensure that you're limiting bad trades, you will absolutely be able to thrive as an options trader. I mean, anecdotally, I can tell you it's true. So here's where the rules come in. You need to be safe with options. They expire worthless. That's not good, right? So you're buying a trajectory. So if I'm buying a call, right, on a day chart, and I start losing the trend that I bought it at, so we're holding this trend. As soon as I lose this trajectory, that's when I want to sell the call. So say I get a good position, I'm going to draw a trend of how this stock's trading, and as soon as we break it, we're going to sell the call. Let me show you what AMD's calls traded like this day. So what we can do is we can click the trade tab from here, pull up all products, go to the July 9th, and because we've gone up so much since then, we're going to do an at the money call just because we wouldn't have been that far out. So back to our charts tab, we're going to copy paste that call into here and then copy paste it over into an options watch list, right? And now this options watch list here, you're going to link it to red or whatever color you'd like. That is a separate chart next to the underlying, which will be linked to your watch lists. So now you can pull up, say I want to look at this AMD call, and say I want to look at AMD as it was trading on Friday, June 25th, so last Friday. What would I do? Well, I'd zoom out of this so I could see it, so I'd go to a 9-minute chart or something. Oh, that's so funny. That's so funny, guys. This happened today, and I thought, I'm sorry, it's getting late. I was like looking, I was like, why can't I see the past on this? Okay, so as we'll see from the day's start till here, you can see the option price. And what I want you to look at is how it trades. So we'll pull up the same time frame, so 6 minutes on each. And I want to look, specifically I want you to look at the call pricing that you're trying to buy and how it traded from open to the bull trap to our expected entry, and why it's so important not to buy calls when the relative volatility is still high and we're still correcting. So in AMC, for instance, it's a really bad time to buy calls, or it was until probably next week. Now, look at this prediction model. That's pretty awesome. If you had bought this call as soon as you identified an A down here and a B up, right, what you can do, so your A is from the high to the low, so your A down, and then your B up. As soon as you identify that, you bring the price prediction from your, so you draw a line from A to B. Things like to be symmetrical, right? So draw your A to B, bring it over from your B to your C, entry zone, and you would have gone from $1 a contract at 11 o'clock to $1.80 by 2:30. So look, it's a powerful tool, guys. I think I've given you enough information to try to tackle some charts of your own with these simple 3 rules, and if you really, really like them, I will happily go over Elliott wave theory in much more detail. And if you guys want me to go over anything in specific, please let me know. I might consider editing videos. I know that this one won't be super coherent, but I think that all the content is easily digestible and of a high quality. So I apologize for not having the time in the day to edit this, or really any editing skills. I'm exhausted. I've been running on fumes with this whole endeavor I'm taking. Anyways, YouTube, always pleasure. Please like and subscribe if this video helps, and leave a comment in the comment section letting me know what you'd like me to cover next. And please, by all means, share your charts. If you can chart some ABC corrections and predict ahead of time, so I mean live charts, don't trade this thesis until you're comfortable with it. If you can do that, DM it to my Twitter. I will love it. It'll make me happy. Anyways, enjoy the rest of your night, guys. Sorry, this video dragged on a little bit. They'll get better as we move on.